Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and things in the world have dramatically changed. Europe's falling apart, Donald Trump's the president, and more importantly, things have changed on the share market. Bond yields have moved aggressively upwards, and of course, what you invest in the share market has changed dramatically. Well, that's the way it seems. With me to talk about this is Jeremy Bendeich from Avoca and Shane Fitzgerald from Monash. Welcome, gentlemen. Shane, I'll start with you. Surprising, bond yields are backed up and all of a sudden you can't afford to be in the high yielding defensive stocks anymore.
I'm not sure it's that surprising. I mean, bond yields have got to an unbelievably low level. They were always going to invert at some point. Since the election, we've seen US bonds up 60 basis points, but up 40 basis points prior to that as well. So yeah, that 100 basis point movement has really been quite dramatic off the base that we came from.
Okay, is it finished?
Oh, look, I think it's the delta that often matters in these things. I think that change that we've seen is, the first inflection point. I suspect the next 100 basis point lift that we'll see will take a much longer period of time, but they're not going to go up anywhere near we saw bonds in historical levels for a number of reasons.
Okay, Jeremy, if that's the scenario, if that's the backdrop, in that 100 basis point move, we've moved out of healthcare, we've moved out of property trusts, we've moved out of all the bond proxies, infrastructure, into more cyclical stocks. Is that trend going to continue, and should we stay that course?
I think the trend continues so long as we see positive commentary out of the major economies as to how their economies are tracking and whether we actually see this stimulus that Trump is proposing eventuate. And we'll just need to wait and see. But the signs in many of the commodity markets are that people are positioning for that to occur. I think the main thing that we are actually seeing in a lot of forecasts is the delta, as Shane mentioned, just a sentiment changing around the direction of global growth and whether or not it could just pick up from what was looking like pretty weak growth to just starting to tick up, and that's all it takes. With some of the imbalances,
the stocks to do well.
Yep.
Because Shane, we were always scared, petrified when yields backed up. Bond crash, equities fall, taper tantrums. Now we've had the great rotation. The equity market, especially in the US, are going up. Do you expect that to continue as bond yields jack up?
Well, I think a lot of it comes down to what Trump's actually going to do, and more than what you can actually get away with, I suppose. Mm-hmm. He does have control of, the Republicans have control of the House and the Senate. So you imagine a lot of stuff he wants to do will get enacted, probably in a watered down form. But look, overall, I think it's the pace of the change that really matters here, and that sharp correction is what really unseated things. So you expect things like resources and the long duration stocks to do badly, but out of this fallback, undoubtedly there's a lot of baby being thrown out with the bathwater situations, and undoubtedly there's a lot of good quality long duration stocks out there which are worth investigating.
Okay, let's assume bond yields will keep backing up.
Yep.
Position us. Where are we going to be in this great rotation, and how are we going to make money over, say, a year or so?
Not to harbour the point, it's like I keep coming back to the delta. If you are of the belief that we're going to see a continued sharp correction in the bond market, that we're going to see another 100, 150 basis points soon, it's more of the same. It's you're going to be underweight the infrastructure stocks, you're going to be underweight healthcare, you're going to be underweight property trusts, you're going to be overweight resources, you're going to be overweight selective financials like QB and computer share that have direct interest rate leverage.
Yep.
But I'm of the belief that interest rates, the next movement is not going to be as dramatic because we've had that sharp change. So what we're going to see is just a steady increase in interest rates. So it's more of a headwind for the equity market as opposed to something we're going to really be worried about.
So if that's the case, beginning at the end of the bull market that started in 2009? Or just a pause?
Just a pause, I think.
Okay, Jeremy, what have you got a view on that, the overall market? And if we are going to make money, where do we position our portfolio?
I think that in the early stages of reflation, markets react positively.
Sure.
Because they are seeing the prospect of better economic growth. It's at that point in time when that interest rates have to catch up to inflation that markets start to get very concerned about equity valuations, and we're not there yet. They got very concerned with the defensives and the yield trade coming off. So in terms of positioning, I'd suggest look for selective value where things have been overdone in high quality long duration assets, but also just really reconsider whether you want to be in gold, because that gold trade is looking pretty precarious now, and whether or not you can find selective cyclicals that still have deep value.
And has Australia got many of those, do you think, that are reasonable value?
I think there are a few around where we're seeing stocks at the bottom of the cycle, either a commodity cycle or an industrial cycle, which are, they're looking a little expensive because they've got high PEs, but they're at the bottom of the cycle. And if you can find some things like that have got leverage to a pickup in global IP, then you're going to do pretty well.
Okay, let's go for more of a macro picture. With that backdrop, harder to get returns in equities or easier?
Well, you'll find that perversely there's a decent yield available in some of these cyclicals because they're quite depressed, but they're still punching out a reasonable yield if you're buying them on 10 to 14 times. Mm-hmm. So with the prospect then of perhaps capital upside of 10 to 15%, and when these things rip, when there's a global IP cycle, it's not usually 10 to 15%. It goes a lot harder. So 20%. So you've got some reasonable stocks there with good yield, good balance sheets, and leverage. You can make some decent returns. And
higher world growth, higher yields, easier or harder to make money in the market?
Oh, look,
equity market.
Right now, it's all macro, right? So it's all big sector, whole sectors move as one. As this washes out, though, it becomes a stock pickers market, like it always is. I think fundamentally, while growth is picking up and expected to pick up, I can't see it going back to really heady levels. Okay, we're just going to see strong underlying GDP growth and revenue growth. I mean, what we've seen for the last 5-6 years is two parts of bugger all top-line earnings growth for the majority of stocks out there, right? So, come back to what I said earlier. I think in this washout that we've seen, there's going to be some really good quality growth stocks out there that their fundamental story is intact, what they're doing in their business is intact, hasn't changed, and those stocks will eventually be rewarded as the earnings come through.
Okay, so change creates opportunity. Good times ahead.